No, not really. In fact, I've been involved with the trust since 2011. I was co-managing it with Stuart Parks from that time. I was responsible for the stock selection, and Stuart was involved in providing the top-down approach for the asset allocation of the trust. And going forward, we continue to see that it's quite important to combine both top-down and bottom-up approaches to allocating the fund. We think it's important to do top-down analysis in Asia because increasingly we're dealing with quite a diverse region. On the one hand, you've got relatively underdeveloped countries like India or Indonesia, and at the other end of the spectrum, you have countries like Australia, Korea and Taiwan that are quite mature and growing much more slowly. And as a result of that, we also have a situation where countries are relatively early in their credit cycles and economic cycles, and those that are more late cycle. So we think we have to have some way of making sense of this. In addition to which, there are also quite diverse valuations across the region. So combining both the outlook for earnings and also the valuations, you need to be able to put that together in a coherent way in order to structure the portfolio. And then from a stock selection standpoint, we think it's important to include both larger companies in the region and smaller companies. In particular, smaller companies, because we think it's quite an under-researched area of the market. And unlike other parts of the world, Asian smaller companies typically trade at a discount to the broader market. And in fact, we've made a conscious effort to increase the weighting over the last few years, and now about 30% of the portfolio is below $3 billion market cap. Well, I think the main reason that is historically investors have looked to Asia for a way to access higher earnings growth. And unfortunately, the region hasn't been delivering high growth in the last few years. In fact, earnings have consistently been downgraded year by year. And I think this just reflects the fact that global growth has been quite slow post the global financial crisis, which has had an impact on Asian export growth, which has been very weak consistently the last few years. It's also a period during which the Chinese economy has slowed down as it's moved away from its model of growth predominantly being driven by investment. And finally, we've also had quite a strong credit cycle in Asia, and that has resulted in some pockets of overinvestment. So there are certain industries in the region, particularly in the more cyclical areas, where there has been a lack of pricing power, and so that has placed some pressure on earnings growth. Well, Asian valuations are now quite low by their own historical standards, very much towards the low end of the range. And when you compare Asia to other global equity markets, Asia is also trading in now at a substantial discount. So valuation support is very strong. In addition to that, I think there's been a negative perception caused by people's concerns about the outlook for China, and that has, I think, played a big part in compressing valuations. From my point of view, I think that people are now perhaps too negative on China, certainly in the short term. And there are signs that we can see from the last 6 to 9 months of the economy actually stabilizing. And that's principally being driven by the property sector, which has been showing some signs of revival in the last few months. And with a time lag, that's also starting to show up in increased demand for construction and material sectors. So I'm not particularly positive on those sectors of the market, but I think it could help to change perceptions of China and maybe remove some of the pressure on valuations that have come about as a result of the concern about China. In the last 9 months or so, as the Hong Kong-China part of the market has been coming down, we've been seeing increasing opportunities there, particularly because we think that the market or consensus has become too negative on China. we think this is representing opportunities from a bottom-up point of view. This doesn't necessarily mean that you need to invest in material stocks. This negativity about China has had a much broader impact on market valuation. So one example would be the Chinese telecom sector, where there is a clear trend towards consumers taking up data services and being prepared to pay more for those services. And as a result, earnings growth is beginning to accelerate. When we've seen those trends in other markets like Indonesia, that has led to a re-rating of the telecom sector. When it comes to China, we haven't seen that re-rating. And when you compare valuations, the Chinese telecom companies are typically trading at nearly half the valuations of their comparators in other emerging markets. So it's just an example of an opportunity where there's been a negative halo effect from China. Well, the framework that we use to determine the gearing of the fund is driven by market valuation. So we tend to increase gearing when valuations are low by historical standards, and vice versa. We would tend to reduce the gearing when valuations are high.